Welcome back to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm really pleased to have Alasdair Macleod with us once again. As most of you know by now, Alasdair is the head of research at Gold Money, and you can read his very insightful weekly commentaries at goldmoney.com, and I believe they usually puts them out about the middle of the week or so. Alasdair is with me today to talk about some of the very dangerous market conditions that are swirling around us during this Chinese virus pandemic, I would suggest intentionally named COVID-19 to disguise its origins, but that's another issue I suppose we shouldn't venture into on this show. But deceit and deception is certainly the world of politics, and no matter what area of your life you're talking about. Our focus here is mostly on economics and the markets, so that's what we'll stick to. When it comes to looking at the dangers, understanding the markets, I don't know of anybody I trust more than Alasdair Macleod, which is one of the reasons he is one of our most frequent guests here. Thanks for joining me again, Alasdair.
That's my pleasure, Jay.
So good to talk to you. Always good to have you, and I know you're certainly one of the more popular guests on our show. So I'd like to focus on, I think it was your April 9th missive titled The Looming Derivative. Well, actually, it had to do with the destruction of bank credit. I guess that's what the destructive forces of bank credit. Then I'd like to get to one you wrote later, more recently, I think April 16th, that's the looming derivative crisis, if we can venture into that one a little bit as well and how it might impact the gold prices that we're looking at every day. But going to your April 9th missive, in the overview of that article, you started out by saying, and I quote, commentators routinely confuse the deflationary effects of a contraction of bank credit with the inflationary effects of central bank policies designed to offset it. Central banks always ensure their stimulus is greater, so inflation, not deflation, is always the outcome. End of quote. Well, I'm certainly in complete agreement with that, but in looking back at the results of 2008, most people believe the central banks actually allowed us to survive that very scary event, and that the fiat monetary system is, if you believe what you're told, alive and well, nothing too much to worry about there. The banks are supposedly very well capitalized this time around, so never need to worry. But, of course, it's not always that simple, and what we're told on the surface is one thing. But can you explain why you think most people believe, other than just propaganda? I mean, where are they going wrong? Why are the commentators wrong in suggesting that everything is honky-dory?
Well, you referred to the 2008 crisis, and certainly the American banks are better capitalized, but you've only got to look and see what the bank position is in Europe to realize that actually Europe is very dangerous. I mean, what they call globally systemically important banks, the G-SIBs, the very big banks, the ones which cannot under any circumstances be allowed to fail, are meant to have buffers. But if you look at Deutsche Bank, the balance sheet is 22 times shareholders' funds. You look at Barclays in the UK, 22 times shareholders' funds. You look at UBS in Switzerland, 17 times shareholders' funds. These major banks are undercapitalized. They cannot absorb much in the way of losses. And that is the problem. When bankers are greedy and everything's going nice and hunky-dory, then they will expand their balance sheets. They will take on extra risk because you have extra risk, you get better margins. And that is a process that accumulates over the credit cycle. But then you get to a point where it all starts going wrong. And we saw this with liquidity problems arising last September. Now, this is some 4 or 5 months before the COVID crisis actually hit us. So we were already running into, if you like, a bank lending problem. The banks were beginning to be reluctant to lend. And when they start, let's say, that they stop looking at, the profits that they can make by expanding their balance sheet, and they're greedy for that money, when they turn around and say, we're worried about risk, then what really informs them is 22 times shareholders' capital. The gearing works in reverse. If you lose, look at Deutsche Bank. If they were to lose 4% of their assets, their shareholders would be wiped out. And the same with Barclays, and nearly the same with UBS. So you can see how bank directors can literally turn on a dime from greed to abject fear. And that is actually what we're trying to deal with. And while that's happening, of course, the Fed and other central banks have this COVID crisis suddenly foisted upon them. They're trying to get money into the payments chains. They're trying to stop industry from falling over. And of course, they expect the banks to transmit the money to these people. But the banks are reluctant to do it. So you've got this problem that the Fed wants to expand the quantity of money, which it will do come hell or high water. And the banks are reluctant to transmit it to their riskier customers. So, the small and medium-sized enterprises that banks lend money to are not really going to get that money easily, which is intended for them from the central banks. And it's not just the Fed, it's the ECB, it's the Bank of England, it's the Bank of Japan, and so on and so forth.
Yeah. Well, Alasdair, can't they, one of the things that they're trying to do here, and I presume in other Western countries as well, is to directly put money into the bank accounts of citizens. We're seeing, I don't know how many billions of dollars already are being transferred to small businesses. I think today there's supposed to be a second part to that, another, I don't know how many untold billions of dollars that are being transferred right into the bank accounts. And I know that, people that we know have gotten their $1,200 per person into their bank account already. Is that one way around? You're saying you can put the money into the banks, but the banks don't really want to lend to people that don't have jobs, to companies that don't have any revenues. So is the way to do it then, the way they're trying to do it, to get around it, is to just put money directly into the hands of individuals, and why can't they do that in unlimited amounts?
I think we're looking at two slightly different issues here. As far as the banks are concerned, if someone, let's say a small business, and let's keep individual people out to one side for the second, but if a small business owes the bank money and the bank sees increased risk in the business environment, then any money that is given to the bank to pass on to that business, as far as the bank is concerned, thank goodness for that, we've got our money back, goodbye. So that's the first problem, okay? Now we're looking at individuals, and this gets us into a completely different problem. We're talking helicoptering money.
Right.
And so if you get a family of four, there's $1,200 per adult, and then there's an extra $1,000 for two children. So, this money is lovely, because what it means is that, whereas the family was living paycheck to paycheck, they've just got that little bit of room. But where do they spend it? The answer has to be the only thing they can spend it is on the shops that are open. And these are for necessities. These are for food and things like that. But we have a problem with food, and that is that the supply chains are not working. I hear that some extraordinary amount of milk is being dumped by American farmers because they can't get it to market. You've got, sort of meat packing sheds can't send out meat because they haven't got the packing stuff, if you like, to pack all the meat in. So you've got supply chain disruption, not only undermining, sort of electronics and motor cars and so on, but the whole of the food processing industry. And so you've got a combination of money being focused, spending money being focused on that industry, and at the same time, the industry unable to deliver. So what happens to food prices? Well, no prizes for guessing. They go up. And not only do they go up, but they go up quite a lot, and they continue to rise. And this is a problem, I think, which is going to be very much center stage in the coming weeks. And, of course, the politicians always take the line of least resistance. They say, well, we must stop businesses profiteering from people's misery. So, any business that's profiteering, we will go out and hit them over the head. Or alternatively, the next stage is they turn around and they say, we are going to put price controls on so that businesses can't profit. And then you're into the familiar territory, if you like, of just destroying the whole delivery process. Because after all, I mean, prices are the result of the balance of supply and demand. And if you've already screwed it up, then, sorry, government, but it's down to you. It's not down to the market. And to try and whip the market, or treat the market as a whipping boy, as we know, going all the way back to Diocletian, who wrote price edicts in stone in about, I think it was 230 AD. And the result was mass starvation, because nobody would dare, sell food to the public in case they were accused of profiteering. So shops shut down, people had to leave the cities, and they went into the country and foraged. And, but we forget these lessons of history, I'm afraid.
We do, and the very simple laws of supply and demand. Price gouging is the first term you hear all the time during situations, whether it's a hurricane or one thing or another, and people. And what I think that's so short-sighted. Sure, I guess there are people that will take advantage of other people. That's unfortunate, but at the same time, to get people to do things that are difficult, sometimes you have to give them a monetary incentive. And there has to be, you certainly don't ask people to go, you can't force people to go out and do things that are costly to them if you're going to have free will. And that's what I worry about most, Alasdair, coming out of this environment, is a lack of our freedom or a lack of our ability to act in accordance with our own needs and do it civilly anyway. But I think you would agree that this we're facing something that's potentially much more damaging, much more long-lasting and difficult than 2008, right?
Yes, of that there is no doubt. I reckon that before this virus shut everything down, we were already heading for something on the scale of the Depression of the 30s, preceded by a collapse of Wall Street when it lost 90% of its value between October 1929 and 1932. I'm not going to go over that ground again because I think your regular listeners are probably aware of my views on that. What the virus has done is it's actually brought forward a lot of the problems which are already in the system. Right. And of course, the Fed's only response to this, having reduced interest rates to zero, actually before this happened, with the yield on U.S. Treasury debt under 1% for everything but the 30-year bond, with negative yields throughout Europe and all the rest of it, there is only one tool in the monetary box that the central banks have, and that is to print, print, print. The amount of printing that they are about to embark on, I mean, they've already made the announcement that they'll do whatever it takes, or it will be infinite. But the amount that's required basically is the amount that's required to ensure that bond yields do not rise and that financial markets, financial assets do not lose value. They are going to try and support the whole of the market system, because if that goes, then they will have lost, and they will trash the currency in an effort to do it. Now, the last time, and I think I'm probably repeating myself from an earlier broadcast with you, the last time this really happened was John Law, France, 1720, and the Mississippi Venture. And what he did was, in order to support the shares of his Mississippi venture, he had to print and print and print money to buy those shares. He ended up not supporting the shares. That overwhelmed him, and he ended up trashing the currency. So by around about February, when the merger of the Mississippi shares with the Banque Royale was due to happen, to the final demise of the whole system and the worthlessness of the currency, took 7 months. Now, this is interesting because, if you really look at the way inflations progress, of a fiat currency, you have a long phase, which can be many decades, or it can be, say, 4 or 5 years, of a gradual loss of purchasing power of the currency. Now, the currency might lose 99% of its purchasing power in that period. But then you get a second phase, and that is when the people who use the currency wake up to what's going on. It's not prices that are rising, but the value or the purchasing power of the currency that is going to hell. And when they wake up to that, there is nothing a government can do, really within reason, to stop the complete collapse of the currency. Yeah. So this is where we are. We are where John Law was in February 1720. We are 300 years on, plus a month or two, and it looks to me as if we will be extremely lucky to have a fiat currency system operative by the end of this calendar year.
Oh, that's pretty dire, I think, because in the meantime, you know that politicians are going to do things that aren't within reason to try to hold it together. I mean, I don't know if it's the John Law incident or in France, I think sometime maybe before the revolution took place. In fact, there was a situation where the currency was getting out of hand. It was hyperinflating, and the farmers demanded gold, as I recall reading, that farmers demanded gold for their payment rather than the fiat. And the government turned around, and anybody that owned gold was beheaded, I think, if I have the story right. So go ahead.
Yeah, sorry. That was, I think you're referring to the currency situation at the time of the revolution, which was when the French government issued a new currency called the assignat.
Yes.
And this theoretically was secured on property that the state had stolen from the Catholic Church. Sorry, sequestered from the Catholic Church. And of course, like every government before and since, when they had this means of issuing something that got revenue in, they issued some more and some more and some more. So they collapsed the assignat, and then they had another bright idea. We'll have a reset. Let's have a monetary reset. We'll issue a new paper called Mandat Territoriaux, and the Mandat Territoriaux lasted 6 months before it just went. So they went through 2 hyperinflations in the space of less than a year.
Yeah, well, I hear them talking about resets. James Rickards is my guest next week, and he talks about a monetary reset with SDRs through the IMF. I think he thinks that's what they might try next. Any ideas? Any notion about that?
Well, it's just fiat in another guise. I mean, you know, I don't know. I mean, I know James has long thought that this would happen, and he's probably closer to the people, if you like, in the United States establishment, you know, who would be thinking this way. But it won't last. I mean, they could well try it, but it's just another form of fiat. I mean, what is an SDR? It's a bunch of fiats. And that's
it's a bunch of fiats. What do they attach some gold to it too, possibly?
Well, I think I'm right in saying, I'm not entirely confident of this, but I think I'm right in saying that anyone who is any currency which is part of the SDR, the rules are that they cannot attach themselves to gold in any way.
Yeah, I believe that's correct. Well, Alasdair, in your article, you talked about you said that the banks there's going to be a lot of bank failures over the next number of months. You believe, but that those that will survive will need to expand bank credit anew to buy up physical, tangible assets instead of their normal financial fare. So I guess by that, you probably would start out with gold and silver, perhaps, or what? What do you have in mind there when you say financial assets?
I was being slightly cheeky on that because I think the one thing that will go is all financial assets, bonds, equities, and all the rest of it. They will be valueless. I mean, well, they're bound to be valueless if you can't value them in a currency which has got no value, sort of thing.
Right.
So, in any event, the bond story is, I mean, that is just bad money. It's just going to go. If you sort of want to profit out of this situation, then what you've got to look at is not financial assets, but real assets. So what you do is, at this stage, you probably have gold. You might even go to the bank and say, right, I want a fixed term loan for 2 years. What's the interest rate going to be? Put up whatever collateral. You're borrowing in fiat. You know it's going to be valueless when you come to repay it. So you take that fiat, buy gold, sit on it, wait. And then what happens is that when people are in real distress, then they will sell you their physical assets for a real knockdown price. And there was a very interesting passage, which I'm quoting in my next article, which is due out this Thursday afternoon, about what happened in Austria. I mean, you know, they had their inflation slightly ahead of the German inflation. And basically, you know, people were staying in really smart hotels for nothing in their own currencies. And when Germany went belly up with their inflation slightly afterwards, this author quotes $100, which of course was backed by gold at that time, could buy you a street of 6-story houses in a major city. You know, so that's the way to be. And the model, if you like, was a chap called Hugo Stinnes. Now, Hugo Stinnes was known as the inflation king. He borrowed money hand over fist to buy real assets. He bought factories, he bought country states, he bought, you know, all sorts of things like that. You know, the real stuff, nothing financial. He ended up owning about a quarter of Germany when the whole thing blew up in the November 1923. Unfortunately, he didn't live very long to enjoy it because he died on the operating table having an operation. I think for gallstones the following year. But it shows you how to play the game, how to rob people, how to work with the inflation to rob people of their assets.
So, Alasdair, do you think there are some banks that are lining themselves up in that regard now? Because I'm thinking that once you hyperinflate and the currency loses its value, they won't be able to print so easily to go out and buy those assets, right?
Well, no, they will be able to print so long as there is a currency. And I would think that there are no bankers thinking on these lines yet. But if I had to nominate a bank which is smart enough to do it, I think it would probably be Goldman Sachs.
Yeah, I wouldn't be surprised. So there are hedge fund guys like Ray Dalio, for example, and a few others, I dare say, that are seeing the end game here, or at least perceiving it's going to end badly for fiat. Dalio certainly is a believer in gold and talks about all the time you have to have some. So I would imagine there's people that are playing this game right now, borrowing in fiat, have been borrowing in fiat, and did exactly what you suggest they should do, is buy gold and then pay back with worthless money in the future.
Absolutely. I mean, there will be some people, as you say, who are already beginning to see this light. Now, having said that, I don't think they see it quite as starkly as I do. Because remember that all the hedge fund boys, all the banks, I mean, they only account in fiat, they only understand fiat, they don't really understand that gold is money. They understand that gold has hedging properties, if you like, without telling us what those are. So it's going to be an interesting one. There would be a lot of education, and I'm afraid an awful lot of pain for ordinary people, which does upset me.
It's going to be a painful education for ordinary people, which is what we try to help people on this show understand what's coming. And speaking of bankers that are hedging and so forth, they think they're hedging with paper gold, right? They're borrowing, they're not buying and not really taking physical possession of gold. They think they can just go out and buy some futures contracts, some options contracts, and they think they actually own gold. But there's a lot of people, gold bugs, that are suggesting that maybe one of these days these people are going to wake up and want to and not be content with paper, realizing what's headed their way, and might want to take physical possession. And I believe, if I'm not wrong, a little bit of that may have started already.
Well, Yes, I think that is true because it's becoming a lot more apparent that currency is being debased. Fiat currency is being debased very rapidly. And there's only one thing that can happen, and that is that sound money is where you should go. That is the refuge, and therefore people will buy gold. Now, having said that, the banks are accounting in fiat, as I said earlier, and they are still playing the fiat game, and they have got caught out. I mean, what's happened is that if you like, bankers are now very, very worried, as I said earlier, about expanding their balance sheets. They want to contract. So they're turning around to their bullion desks and saying, they're either saying, we want out of this game, close down your positions, or they're saying, reduce your positions. And that means that all the bullion banks at the same time, because this is a feature of contracting bank credit, one banker does it, they all do it. They're all being told at the same time, we want to reduce our exposure in this market, or they're being told, we want out of this market. And this is creating a panic amongst the bullion banks. They're being forced to close down their positions, which is why you've got this extraordinary premium building up in the futures market compared with London. And I think when it comes to the price of gold in London, I wouldn't say that's the right price either, because the bullion banks are at both ends. And you can see that the LBMA and COMEX are trying to collude to keep the show on the road and to stop enormous losses accumulating in the hands of some of these banks. And I can tell you there are enormous losses accumulating in one or two of these banks. They really are very serious.
Well, it's just about a minute and a half left or so, Alasdair. Help us understand this. The bankers, the bullion bankers, in order to get out of the business, what do they have to do?
They have to close down their short positions.
Okay, that means they have to go out and buy gold then to repay their...
Exactly.
Or it's just paper contracts. They don't have
it's paper contracts, but you see that you've also got another problem now, and that is, as we saw with the April contract, people are standing for delivery, which they can do under COMEX rules. Now, the next active month is June. Now, you might say that with a premium on the June contract compared with spot in London, that nobody in their right minds are going to go and stand for delivery when the June contract matures. But that assumes that the right price is the London price. It's not. It's not, because of what's happening. The central banks are telling us, for goodness sake, we're going to print as much money as we possibly can, and there's no limit to it. So we all know what's going to happen to the price of gold. So if you've got a contract, a June contract, and you want to, you're wondering what to do with it, you probably stand for delivery. So this is going to be a very, very tough time for the COMEX market and the bullion banks that operate in it.
So we should see some much higher gold prices denominated in dollars and other fiat, I guess is what you're saying.
Well, yes, I mean, from every angle. I mean, basically what's happened is that the game has changed hugely. I mean, these boys are quite happy to, sort of, if you like, start from an even position, run the price up, get all the speculators in, then crash the price,
right? Take
the money off them. That game stopped, and they've got caught short.
So you think that game is over now, Alasdair? You think that's coming to an end, and we're going to see some real sparks flying now in the gold markets? All right, we'll have to leave it go at that. Thank you so much again for being with us, Alasdair. It's always a pleasure. Thank you for helping us understand these complicated markets.